It may be volatile, but our next guest isn't ruling out a massive rally within a week. Tom Lee is the head of research at Fundstrat Global Advisors and a CNBC contributor. Tom, good to see you. What do you make of? I know you've been listening into our conversation. What do you make of Dan's, forecast or thought that we could be setting up for a similar sell-off that we saw last year?
I understand the rationale. I think if we look at sectors that were leading this year, the sell-off Dan's talking about kind of already has taken place. And I think in terms of how investors are reacting to the incoming data, last year it was concerns about back to school and the rising cases, and cases were surging. Plus we had the whole election issue going into the fall. I think the market is dealing with a lot of bad news today. And the question that investors have to grapple with is how much of what we're seeing, especially with Delta, is looking a little bit in the rearview mirror, because Delta could be peaking soon, or a lot of the setbacks and uncertainties that are being created, how much of it is transitory versus permanent changes. Example is a lot of our clients today were talking about canceled trips, and they're seeing some of the high frequency data show some of the weakening. But that stuff could change as soon as we get some comfort on Delta's improving or the benefits of boosters. And so, I'm in the camp that I think a lot of bad news is baked in, but I think in the next week we're going to see more bad news, but markets start to not react to that bad news. And I think that's what makes a bottom, and then, of course, a big rally.
Hey, Tom, so a big rally from here. You have the S&P 500 up 17% or so. I guess when I think back to over the last 5 or 6 years, some of the most volatile periods in equities have had to do with Chinese growth. And when you look at some of the data that we've seen just in the last few weeks, you could say it's Delta, or you might say that they came out of their recession quicker than, let's say, we did. Maybe there's a scenario where growth doesn't materialize globally the way that a lot of people had expected here, and therefore maybe equity valuations seem a little rich. And my point is, I'm not trying to scare anybody out of positions or anything like that. It's just that if you believe that we're finally going to get that reopening trade, wouldn't you like to see a little fear in the market rather than just this complacent grind higher that we've had over the last few months?
Yeah, I'd agree with you, Dan. Fear is always good. But if you look at the VIX term structure, it's showing quite a lot of fear. It's not inverting, so it's not like the market's trying to price in some big high vol event in the near term. And in terms of the cycle, because I think you are referring to the risk that if China's weakening, maybe the cycle's peaking, the business cycle. But there's still so much pent-up demand. We know households are really liquid. There's going to be revenge corporate capex. We know buybacks are strong. And companies have really cut their cost structure. So they're not going to necessarily trip over their skis if there's a short-term bump because mobility is weakening. And so I just don't think we're at that point where capital's misallocated. I know investors are scared. I don't blame them. Today, this morning was a tough session to watch, but, to me, that doesn't change that the markets can be really capable of a big rally.
Tom, you heard Melissa ask Nadine about whether it was the Fed or the variant that made the most. I happen to think the Fed still trumps everything else. I'm just curious as to your thoughts. Could they potentially say something in the coming weeks to sort of derail this, or have they figured out how to speak to the market?
Well, I'd agree. The Fed can have a huge impact either way, positive or negative. But I know they're data dependent. And, I think when the markets start to get soft like this and the soft data that they look at, like consumer confidence is weakening, I just think it's harder for them to be decisive in a decision. So I'd be in the camp that what's happening now is actually less likely to lead to a Fed negative surprise.
All right. Top pick still energy. I still like tech as well. Tom, good to see you. Thank you so much.
Yeah, thanks for having me.
Tom Lee of Fundstrat. Pina Jarian, tech or energy?
Oh, now you're going to make me pick. I will go with tech. I have a lot of exposure in technology. I still think that there's plenty of upside. So I like them both, though, Mel. As you know, I was talking about all those options I have in a lot of different energy names as well. But if you're going to put me and I got to make a pick, would I rather? I'm going to go. I'm going to go with tech.
I didn't even force that.
No, you stealthed it, though.
You
stealthed would you rather him. That's not fair. You snuck it in.
I may walk down that path. But Nadine, it's an interesting portfolio to construct to think that, you're all in on cyclicals and you also like tech.
Well, I agree with Pete here. I'd have to go with tech. I think that while it's owned, there's a lot of protection on right now. So those are the types of things that if people unwind that protection, that can move it higher. There's also pretty solid balance sheets in some of the big players. Obviously, a lot of strategic initiatives going on. We heard from Zuckerberg today. Obviously, it's more of a 10-year plan. But I think that there's a lot of exciting developments. And if you end up having a variant that, your second thing versus the interest rates that continues to keep the GDP acceleration kind of at bay, you could see rates stay low and tech continue to grind higher. So I think the asymmetry is there in tech.